is kind of wild.
You ended the statement with negative $58 on October 5th. You can't get ahead of it when you got credit card debt. So you're just essentially lighting $170 a month on fire right now.
I feel like it's also gone counter to like the things, but I hear you.
Credit card debt, frankly, is probably the worst debt you can have besides a payday loan.
You're like, you got a spending issue. Oh, delete all your savings, clearing out this debt, live with no money in the bank.
That money's not technically yours if you owe people money, and you're going to screw yourself long term.
Hey, my name is Jean-Jacques Encyclo, but going by JJ today. I'm from LA and I'm about to be 29 years old.
What do you do for work out in LA?
I'm an actor and model, as it goes here in LA.
And how long have you been doing that for?
Honestly, since the writers-actors strike, I was working for a director, like on my way to being creative exec, but I came here to be an actor. Took the opportunity of my office closing down with the strike to push out in this new direction, and it's been so far so good. So trying to see if I can make it work.
I guess a few months full time then, it sounds like.
Yeah, full time, fully committed. That's the biggest difference. Because I've tried it like once or twice before, just never committed to it.
Okay, and what's the expected income on an annual basis pursuing acting full time? Obviously, you've only been doing it for 5 months or so, but
yikes. I mean, I don't know. That's the biggest thing. Right now, I've made like 15,000 in the last month, 2 months. But like this month, I haven't booked any. I mean, I actually just booked on a $5,000 ad, but then it canceled, and I got 500. So on to book the next big one. I had a few $10,000 opportunities, but yet to book them, So
currently it's uncharted territories, but I mean, making 15,000 the last 2 months is great. How much would you say you've made over the last 5 months since kind of taking this leap full time into it?
Well, I've only been doing it for about 3 months, so that's what's like made it so like feasible. Was well, I'm not gonna lie. There's like 2,000 of that 15 that I'm like waiting to get that this show hasn't paid me on. So there's like that wrinkle of it too. But it's only been 3 months, and it's been like, I would say 15,000.
Okay. Well, I guess 15,000 is 3 months is 5,000 a month. So annual basis 60,000 if you keep that up. But hopefully deals will start coming in again. Probably will be after the new year because we got Thanksgiving next week. We got holidays coming up in December, New Year's. I mean, I'm assuming stuff is going to be pretty slow over the next 6 weeks to end the year. So that means you're going to have to start hustling for work starting in January, February, and March at this point, probably.
Well, to be fair, in my world, we actually book a lot. I'm going to hold out through the end of like mid-December just for holiday stuff. But yeah, and then there'll be a big drop.
And how much did you make in your previous full-time job before the strike started?
Made 80,000.
Okay. So definitely was living okay out in California off 80,000, or what was your situation before the whole strike?
I was doing all right. It was definitely happy to be, because before that, I think I was making like 50 working for some assistant or something like that. Maybe if that, like 40. So it was rough leading up to that.
Yeah. Okay. So you're going from 80,000, which is about $5,000 a month net in California, to now making 60,000. I mean, your net will be probably in the ballpark of $3,700 after you account for taxes on $5,000 a month, about $3,700 a month after accounting for some taxes on that $5,000. So definitely is a pay decrease of about $1,300, but you're just getting started. So hopefully that will continue to rise and not just be the high end we're going for right now. So. Well, how would you define your current financial situation? Obviously, you've been through a lot. Jumping into this full time, the strike and everything happening. Where would you put yourself 1 to 10?
Probably about like 5 or 6. I'm not doing too poorly. Like I'm definitely not broke. But things are expensive, and also I'm not like necessarily like I know I spent a lot in the last couple months, and I like need to curtail that. But I was also like trying to afford, invest in myself at this startup kind of venture, like paying for photographers for shoots and stuff, which really happy with the results, but now they need to start paying dividends.
Let's talk about current debts and assets then. Do we have any debt right now?
Yes. We're about, I want to say like $6,000 or $7,000 in credit card debt.
Putting yourself at a 5 or 6 with $6,000 in credit card debt. That means it's not a good spot to be in having credit card debt.
Well, I'm like confident that once because like I could clear it, but I'd rather hold on to the funds that I have at the moment, possibly invest those. And I think right now my debt is at a manageable level, so I'd rather find ways to pay that off through the investments or anything I make moving forward.
Okay, so what other debt do we have besides the $6,000 of credit card debt?
Just student debt.
Okay, and how much in student loans?
I want to say like another 20,000.
You gave me 33.5, unless that's changed.
Then 33.
33. Okay. $33,000 worth of student loans, credit card debt. It looks like between the two, we have just under $7,000 total. So student loans, 33.5, credit cards, about 7,000. We have about 40,000, just over $40,000 worth of total debts. And then assets. What assets do we have? Retirement account, savings, anything?
I was talking to a tax guy about opening up an IRA, but that's like we're starting that now. And at the moment, I own a car, but that's it.
Okay. What's the car valued at?
I don't know.
Ballpark, 10,000, 15, 20,000?
Let's say 10 at this point.
And then savings. We have anything in savings?
I got like 47,000. See,
Yeah, 47,000 in savings. What are you doing with 7,000 in the credit card debt then?
I want to make it through tax season. And as I mentioned, it feels like, I don't know, I'm at a survivable level with the credit card debt. And I'd rather, instead of paying off $7,000 in debt, possibly invest $7,000 somewhere.
Okay, so how much are you gonna need for tax season next year?
I'm saving 10 grand.
Okay, 10 grand for taxes. So I guess let's go assets right now. We got 10,000 car, $47,000 in your savings. That's $57,000 worth of assets. Total debt, 40,365. Your net worth at 16,634. And if you were saving $10,000 for taxes, you still have $37,000 in your bank account. And right now you have $7,000 in credit card debt. Do you know how much you're paying every single month to the bank to keep these balances open? And do you know what the interest rate is on credit cards?
I don't. I mean, I should, but
frankly, it's probably the worst debt you can have besides a payday loan. Payday loans are higher interest, but credit cards are anywhere from 20 to 30%. Looking at yours right here, your Discover card is 26.24%. And so last month alone, you paid $169 in interest to the bank. So out of your monthly, it looks like you paid $4,000 down on it last month. Okay, you paid $4,000 down, but by keeping that balance open, your minimum payment's technically $190. So if you paid the minimum payment $190, $169 of those dollars goes to interest, and only $21 goes towards the principal. And so credit card debt's accruing at 26% interest rate. And you're sitting there talking about, hey, I want to go invest this money somewhere else in your modeling, acting, career, whatever. And I'm all for doing that. But if you're doing it at a sacrifice of 26% interest, it's going to destroy you, because there's a reason credit card companies' bottom lines are beautiful, because they make 20 or 30% of their money. The average return, whether you put in an IRA and any type of retirement account, if you're putting in index funds, you're averaging probably between 7 and 10%. And 7 to 10% is a lot lower than credit card debt at 26% we have right now. And if you're keeping that money in your checking account right now, which it looks like, it's not even accruing interest, or if it is, it's minimal. I don't even think you have.
No, I don't think it's getting interest.
Yeah, it's not even getting interest. So you're just essentially lighting $170 a month on fire right now by keeping it in your checking account versus paying it off. Does that make sense?
I mean, that's how much was it? $178?
$169.
$169. Well, that's like an expense that I have to pay. So that's coming out of like whatever income I would be making. But I hear your point.
Yeah, but you've paid $1,600 to the bank this year when you got the money in your bank account. That's $1,600 that you could be using to invest in your photo. That pays for a photo shoot right there, or two. But instead, you just kept the money in your bank account, which is just.
Well, I've had it. It's only been there for like a month, so I've only paid theoretically. It's been like how best to move forward at this current juncture.
What do you mean? You've only had the $40,000 for a month? Or
Yeah. The 40,000. It was a recent gig. Let's say that.
Okay, so even then, keeping the money in, the first thing with personal finance is debt will destroy you, especially credit card debt. And you can't out-earn credit card debt risk-free anywhere. Whether it's investing in your acting career, if you said, hey, I want to put dollar for dollar into your acting career, yes, hypothetically, you could earn a higher return, but it's also risk associated with that, obviously. You could put it into index funds or stocks or whatever you wanted to, but there's obviously risk associated with that. And you can put a high yield savings account, you're only 5.5%. But with this credit card debt, 26% interest is just astronomical. And you've paid $1,500 this year on it, and you kept that balance for the remaining of the next 12 months. I mean, you're going to be paying that money every single month, and it's going to be very difficult to get out of it. And credit card debt is just, you never want to have credit card debt, especially when you have money sitting in a checking account that's earning 0% interest. Even if you're earning 10% on that, you're still losing money on it. And my comparison would be, you're just every single month by keeping this balance open, you're just taking $170. Just go take $170 and light it on fire, and that's exactly what you're doing. So what I would suggest is, hey, you got this $47,000. You need to set aside $10,000 for taxes, so you got $37,000. We got $7,000 that you can go to pay off this credit card debt. So that means great. You got $30,000 left after you do both of those things. That is a great emergency fund to have in your current situation. Does that make sense?
Mm-hmm.
Putting yourself at a initial thought of putting yourself at 5 or 6, I would not put you at a 5 or 6 with credit card debt. Anyone with credit card debt, I think you're below a 3, depending on the amount of credit card debt and your income. Your situation could be a 8 tomorrow. If you paid off this credit card debt, you have $30,000 in your savings account. You can start paying off these student loans depending on what the interest rate is and what you want to do there. But I would move you a lot higher up. Probably not an 8 with the student loans, but you'd be moving to 6, probably 6 range if you paid off this credit card debt tomorrow.
Okay. Yeah, sure.
What do you think about that? You don't seem sold on paying off the credit card debt.
It seems like if I don't want to light money on fire, I should pay it off.
Yeah. And that's basically what credit card debt is especially when you have the money in your bank account, is it's just you're paying a lot of money to the banks to borrow money from them. They don't give it to you cheaply. So if it was 0% interest rate car loan, or if it was a 2% mortgage, yeah, we could have a conversation depending on your risk tolerance, what you want to do. But credit card debt there's not really much negotiating there with credit card companies in terms of lowering that balance. And some people will take that and roll it over to a 0% APR credit card, but that doesn't solve bad habits. It just kind of puts a Band-Aid on it. But when you got the cash to pay for it, it makes 100% of the time, I would say, it makes sense to just pay it off. That puts your net worth, like we said, $16,000. Let's talk about college. What did you study in college? You go to college?
Yeah. Yeah, it was theater and performing arts, hence the acting.
And we got $30,000 worth of student loans. Have you paid some of those off, or what does that kind of look like over the last few years?
Yeah, I've paid, I don't know, like $5,000 of it off or something like that.
Okay. And do you know what the interest rate is on those student loans?
I want to say 8%.
8%?
Yeah, sure.
Okay. So it's high. I mean, there's some student loans. I've seen student loans 3%. I've seen student loans anywhere from 3 to 12%. And 8%, it's not as high as credit card debt, but same thing. If you have money in a high yield savings account earning 5% before taxes, you're really earning about like 3.5 to 3.75 after you account for taxes on a high yield savings account. And then you got student loans accruing at 8% interest. You're essentially losing 4% every single year on that money. So you're not better off doing that. And then you could also invest in index funds, but those again return 7 to 10% a year on average. And that comes with risk associated with it. We could go into a market that returns 2% in the next 10 years. We don't know what the market's going to unfold in the next 10 years. So really anything over 3%, 4%, I'd be paying off as quickly as possible. Some people have the number at 5 or 6%, but personally, I'm a less risk. I want guaranteed returns on debt. I want to get debt out of the picture, so I don't have to worry about it again. So 8% is not debt that excites me. I would never say, hey, invest money. I would never say, hey, pay the minimum payments on it. I'd say, hey, let's figure out how to pay this off as quickly as possible with 8% interest rates. And in your situation, I mean, you wouldn't be able to wipe it off tomorrow because you have to account for taxes next year, but you'll have $30,000 after this. And there's a couple different routes you can go. You can go the Dave Ramsey route, which is he says set aside $1,000 into emergency fund and then throw everything else at the debt. And that would put you at like $4,000 in student loans. I think given your current career field, taking the leap into this full time, I think that'd be a very kind of risky way to do that. Put yourself with $1,000 in your emergency fund, especially with the holidays coming up. So I don't think I would suggest that for this current situation. But what I would say is, okay, maybe not throw $29,000 at it, but maybe you throw $10,000 or $15,000 at it. And then you have $10,000 or $15,000 to make sure you can get through the holidays with kind of stuff slowing down. And then the new year, hey, let's start attacking this debt and get it paid off in the next 6 to 12 months. Because what's your minimum payment on your student loans?
I think it's like $63 a month.
$63? Okay. So it's not a large payment at all. I'm assuming the interest rate might be lower than if it's only $63. Are you on like income-based repayment plans?
I believe so. Yeah.
So even at $63, I'd be wanting to get rid of it because personally, I wouldn't want $33,000 of debt sitting on my balance sheet, especially at an 8% return or 8% interest rate. So that's what I'll send you some different resources on paying off debt, getting out of it. But in your current situation, I'd say clear the credit cards up tonight. Student loans, figure out what is your plan and path to pay those off. Is it taking some of your checking account right now, putting that towards the student loans, and then attacking that over the next 6 to 12 months? Give yourself some buffer with essentially freelancing contract work for people right now since you just started doing that full time, so you don't end up in more credit card debt. But I'd start figuring out ways to pay that off, because if you're working with someone right now to start investing in a traditional IRA or a Roth IRA, you're going to earn, like I said, 7 to 10% on average in those accounts. And if your student loans at 8%, it makes more sense to pay off the student loans first because there's risk associated with investing than try to invest and pay off student loans at the same time. It's just going to cause issues and lack of focus. And you have guaranteed 8% returns if you're paying off your student loans immediately. So does that make sense?
In some regards, because I feel like it's also gone counter to like the things but I hear you. You just want to attack debt, which is smart. You don't want to start invest because like my thing is like tomorrow, if I get like that $5,000 ad that canceled.
Because that's a big what if. That's not a guaranteed. We have the guaranteed money today to do that, and you can pay that off and save yourself $100 by paying it now versus the end of the month or next month or whatever it is. And then for the student loans, if you want to go that route of, hey, I'm not going to take the $30,000 and throw it all at it. Maybe I'll throw $10,000 or $15,000. And then when you get big deals in January, February, March, hey, I'm going to start attacking this at $2,000 or $3,000 a month to pay the remaining $15,000 balance down. I'm okay with that as long as we start doing it. But you should have a goal of, hey, what can you do to pay this off over the next 6 to 12 months? Because you have cash in your account to do it right now for the student loans, basically. But you need to make sure you set yourself up for success. You don't go to credit card debt by not having gigs, say, for the next 30 days, if that were to happen. But depending on, hey, I'm going to wait until this happens, is kind of what a lot of people do. I mean, frankly, a lot of people say, hey, I'm going to wait till I get a pay raise to pay off my credit card bills, or I'm going to wait till I get a promotion, or I'm going to wait till this event happens to start budgeting my money. And the issue is you always find an excuse to push that further on. You might say, hey, that $5,000 gig comes in tomorrow. I would pay off this credit card debt. But guess what? Between now and tomorrow, you could get a photographer hitting you up saying, hey, come spend $4,000 on a photo shoot, and you're going to take that $5,000 and go spend it on the photo shoot. And things will come up in life, or your car is going to break down. You're going to use that $5,000 to do that. But you have a guaranteed time to return or to pay off 26% credit card debt right now. And then you still have an emergency fund in case life happens and you need to pay for necessities like getting your car. If you have an emergency fund saved up of 3 to 6 months of expenses, once you pay off all this debt, then hey, guess what? That's going to give you freedom when a car inevitably is going to break down. You'll be able to pay for new tires or new transmission or whatever needs to be fixed because you have money saved in the bank. But right now, debt payments get in the way because we got credit card payments right now. I mean, you got $200 some worth of minimum payments right now between the two different cards. And student loans, you got additional payments there. So once you get rid of those, you got money back in your pocket.
See, because my line of thinking was, it's not hard for me to make the money to make my minimum payments as of right now. It's really easy for me to do that.
Well, minimum payments aren't supposed to be hard to make because guess what? It's going to take you, if you make the minimum payments on your credit card.
I know it's going to take me a long time, but the idea is I'm not losing money out. Like I'm going out and working to pay for said $175 a month so that I can hold on to that debt and possibly pay it off later. Now, besides getting out of debt, like what else is there?
You want to go out and make more money. So, because you want to, I'm assuming, build wealth and save money to do things, and keeping credit card debt kind of does the opposite of that. And so if you're like, hey, I want to go out and make more money so I can pay off that debt or pay the interest, basically, I mean, you're making yourself work harder to make $170 more a month to even be in the same spot. So, I mean, initially, the best way to build wealth is, step one is to live below your means, which means budgeting and making sure that you're spending less money than you make. If you make $4,000 a month after taxes, you're spending below $4,000. Also means avoiding debt or paying off debt, because 26% interest rates or 8% interest rates are not in your favor. They're in the lender's favor because that's why they lend out money at those rates. So step two is, hey, how do you pay off debt? And you can do that with the credit card debt tomorrow. Student loans, you can kind of do that over the next 6 months. If that's a plan that you want, I would want to get it out of the next 6 months. should have the income to do it if you're bringing in $5,000, $6,000, $10,000 months. Obviously, you have to save money for taxes every single month, but do that. And then once you have those done, then guess what? You don't have monthly payments that you owe to anyone anymore, and you can start saving and investing that money at that point and start building wealth for the long term.
Okay.
So let's talk about, you went to college, got some student loans. What was your childhood like? Where'd you grow up?
San Francisco, good childhood, private school.
Did your parents talk to you much about money growing up?
No. My dad's an immigrant. My mom didn't really come from money, so no, we learned a lot. I think my parents learned a lot through the private school.
Did you learn any financial lessons that you can remember just watching your parents growing up?
No.
Okay. So what's your experience or knowledge or trying to educate yourself about money over the last 10 years or so of your life?
I would say reading Rich Dad, Poor Dad.
And so reading Rich Dad, Poor Dad is pay yourself first, but if we're paying 26% interest rates to credit cards, that's not an asset right there. That's a liability. So, Rich Dad, Poor Dad talks about paying yourself first and buying assets, not having liabilities that kind of drain you, and credit card debts are the opposite of paying yourself first. So let's talk about your current monthly expenses then. So we have net income. If you bring in $5,000 a month, it's about $3,700 a month. Looks like rent is $1,900. We got car insurance $160, gas $200. You put $0 for groceries. Do you spend any money on groceries?
I put in like $200. What, a month? Is it a week?
$200. It's a month.
Oh, well then, yeah, it's around $800.
Okay, $800 a month there. And then we have $600 for entertainment. What are we spending $600 on entertainment for a month? What's included in that?
Like bars, Uber, things to go outside, drinks, the fun stuff.
Health and fitness $300, shopping $200, pet $45. So that brings your total monthly expenses, excluding debt payments, of $4,200 a month. Does that sound about right?
Yeah, we'll say that.
Okay, so if we're making $3,700 a month on average, but we're spending $4,200 a month, then that means we're operating at a deficit of about $500, which means more money has been coming out of your bank account than is going in every single month. Do you budget your money right now?
Clearly not very well. No, that's what I said. The last couple of months have been tight. And also, I would say a lot of those numbers were from when I was making $80,000 besides rent. Because the man knows how to live cheaply, is the point I'm trying to make.
So those expenses have kind of tuned down the last few months since you transitioned.
Right. Definitely. Well, just because I'm not losing money that aggressively. I still have all the money, I still have the money in the bank. And, but, I just wanted to have more at this point. Just because, that's all I can say.
Okay. Let's dive through, I guess, your monthly transactions that you sent over then, because I got a few different credit cards, a few different bank accounts that we have here. And we'll start with the credit card that has the highest balance. So it looks like this one has a $6,100 balance. We spent $342 last month. You did pay down $4,000 of it, but we had $169 worth of interest on it. So it looks like we have in here, you said spend a lot of money on eating out, entertainment. We have a bunch of restaurants on here. We have a smoke shop. We've got markets and stuff on here. So we spent about $342 on eating out. It looks like basically is the entire card right here. I don't see anything in particular. Most of these are $30 transactions, $20 transactions on here. We've got this other credit card that has a balance of $755. So you paid down $25, which is only the minimum payment, and then you made $176 in purchases. So that minimum payment you made of $25, only $12 of that went towards the principal, and you added $13.6 worth of interest to it at the end of that statement by keeping a balance on there. So this is Domino's, one of the markets you go to again, McDonald's, Target, fuel, liquor, more liquor stores, more markets. That must just be Exxon. Okay, that's Exxon, I guess gas on here. So you spend $176 on it, again on little things like food, and most of this is food and entertainment, which you put yourself at between, this doesn't even include groceries, it doesn't look like. We got about $500 worth of entertainment on these two different things. So you're in that ballpark of $342 plus $176. And then we've got this other card. You ended one of your bank accounts with a balance of negative $58. What happened there? One of your credit cards, one of your bank accounts, you started the month with $245. You had $4,500 deposit in it. You withdrew $4,800, and you ended the statement with negative $58 on October 5th.
Well, that one, I think I was paying off debt through that one, and it's like connected to a rollover balance, so I don't really give if it's a negative.
Okay, so it's rolling over from your account that has $40,000 in it.
Yeah.
So, I mean, on this, we do have some different payments on here, but looking at this, I mean, $4,000, I don't see any debt payments on here, any credit card payments. This is all just straight transactions. Because we got, I mean, I'll go through this list, but we got Uber Eats, we've got Target, you spent $312, we got Lyft, we got Domino's, we got more Smoke Shop, you got PetSmart.
Well, what's the name of this account?
This is your Bank of America checking account.
So I thought it was like one of the ones that I paid debt out. It sounds like my main one.
Yeah, this is your main one, it looks like. But we spent $4,800 last month, plus the additional $500 on the credit card. So you spent $5,300 last month, basically across all these different accounts, which is higher than the projected $4,000. And I mean, frankly, with making $5,000, your rent's a little bit high. I mean, it's $900. I know LA is not cheap, but if you're making $4,000, you'd have $2,000 left over each month to kind of pay off debt and do different things. But we're spending a lot more than $600 in entertainment, on shopping, and all these things. I mean, you said $200 a month on shopping, but we got Target alone was $312. We've got over $200 in purchase at a smoke shop within.
Sorry, I just moved. So yeah, those are moving costs.
Okay, so you moved at the beginning of beginning of September?
Yeah, right there, beginning of September. So I was paying, that's rent, the $4,000. That's first and last month's rent.
No, sorry, there's no $4,000 transaction on here, but you spent total across all the transactions, you spent $4,800.
Yeah. Okay. Yeah, but still, that's moving costs, baby.
I don't see moving costs on here. I mean, maybe the targeted stuff when you're buying stuff, but we got, I mean, smoke shops, Domino's, Uber Eats, more smoke shop, PetSmart, obviously. You got to get stuff for your pet so they live. You've got Amazon, you've got Ralph's, you got stuff on PayPal for $150. What do you spend on PayPal for $150 on September 18th and then another $220 on September 20th?
Dude, I gotta look at that. I have no idea.
See, this is $370 that you don't know what it is. And that's why you got to budget your money, because you're going to understand and realize, hey, you're spending a lot more money than you think. And I guarantee if you kind of go through and categorize all these transactions, you will have spent far more on shopping, on entertainment than you would have expected. Because, I mean, looking through this right now, between the Amazon transactions, between the Target, the PayPal, I mean, we're over $1,000 for this month.
Oh, they said PayPal. I'm like, it pay-per-view. That's what I thought you said. I was like, what they, no, I have to know. But yeah, no, there's things I was buying through PayPal. It's just like online.
I mean, I see another PayPal for $150, Amazon for $61. I mean, my point is there's a lot of transactions on here, and if you're not budgeting and tracking your expenses, you're going to be spending a lot more money than you think, because these $20, $30, $40, $50 transactions don't seem like a lot. But when you have dozens of those transactions
yeah, no, that's, I mean, I'm pretty sure I entered this podcast saying I was spending a lot the last couple of months. I need to dial it back. So I'm not, I'm not self-aware here.
Yeah, and that's what I'm just trying to point out. Hey, you got to start, if you want to dial it back, you should start tracking your expenses and budgeting, because then you'll realize how much money you're actually spending. And if you're not intentional about where your money's going, you're going to have no idea where it's going to go. You're not going to be able to build wealth. You're not going to be able to save and invest money in the future if you don't start those habits now. Because last month we spent somewhere around $5,300 between the two credit cards and this bank account. And I think this Venmo for $2,000 on the second was for your rent, it looks like, I would guess.
On the second, yes. And the $250 was for a photographer. Yeah, I remember now. It was $500 for a shoot.
Okay, so we spent $500 on a shoot. So again, we don't even have in this budget of yours right now how much we're allocating towards your career and towards the shoots.
And then there was shopping for the shoots. There's like some Zara and there's some other. But yes, there's also a lot of smoke shops. Your boy goes to the liquor store.
Liquor shops and smoke shops, a few $100s last month at least across those.
Entertainment. I said it's all it's supposed to be budgeted.
I mean, you at least put $600, but it looks like it's more than that. So, and then shopping is definitely not $200. Shopping is way, way more than that.
Because I don't shop. Last month. I was like, I gotta go.
I don't shop. We spent $1,000 shopping last month.
Oh, you mean like on food? Yeah.
That's what I mean. Moving forward, you have cash in your bank account right now. You acknowledge that, hey, you have had kind of spending issues the last few months, but now you got to start deciding, hey, do you want to reel this in? Do you want to start?
Yeah, but this is kind of wild. You're like, you got a spending issue, but I want you to spend all your money. You want you to spend all your money. Go delete all your savings, clearing out this debt, and live with no money in the bank. I'm like, okay, bro.
But that money's not technically yours if you owe people money.
Oh, sure. I mean, I just not pay. You build my
If you don't pay your credit card debt, you're going to go to collections. You're going to garnish your wages. You're screwed at that point.
Oh, sure. I'll just pay them off eventually. But yeah, I hear you.
Then it'll be broke forever. You carry a balance on credit card for $7,000. I mean, that's just going to be bad habits, and you're going to screw yourself long term. And do you want to build wealth? Do you want to start investing and have money one day?
Yeah. I just thought, I hear you. Oh, I'm listening. Let's say that.
You're listening. I guess the question is, are you going to take action on it? You're going to decide to start budgeting, start paying off this debt, don't carry balances on credit cards again, and start living below your means. I mean, those are the keys to life.
Yeah, I mean, it's not rocket science.
It's not. If you make $5,000 a month, you got to spend less than $5,000. If you have debt, you got to start figuring out a plan to start paying off that debt. And I can't force you to do it. I can't force anyone to do it. I can just only tell you, hey, we have spending habits that need to change. We need to start tracking those spending habits, and we need to start taking action on that. So what is your current process, or what has been your process the last few months, taking the leap, working full-time for budgeting your money and tracking your expenses? Have you done anything?
The spreadsheet you sent over. Trying to move just enough money to do a transaction, be like, all right, go anymore.
So when you took the leap full-time, when the strike happened, what was your thoughts about finances at the time, and how are you going to pay your bills moving forward?
I was going to figure it out. So far, I have. It's really been it. Like the first week, I didn't have money to make, first month, didn't have money to make rent. And then I made 10,000. And then the next week, I made another 3. So then I was working a job for the last 2 months. That job just ended. And for the last month, I've been looking for work. Almost got a $5,000 gig. And it fell through, and I'm on to the next one. You know, that's been truly what has happened. I was at a shoot earlier today. That's why we had to push this back. So that's my life right now.
Do you ever look at your bank statements or any of that over the last few months? Because frankly, that would terrify me, I guess, going full. That was the first time I was sending it to me.
Well, I look at it daily. I don't know, when I open up the bank to see if there's money there. I don't know. Like, I'm not inspecting I don't comb through my sheets as we have today.
So you just look and see, hey, I got $500 in there today, or I got $200. I can go spend money.
If so, yes. I'd be like, ooh, that should last a week or more.
Okay, well, what are, I guess, some of your financial goals for the future?
I would love to make my goal. I don't know how close we are. I'm just trying to make like 20,000 in by February, but it would just be to be established in this and like to be steadily able to make like $2,000 a month, but like have built out $20,000 by January.
I think that's a great goal to have, and I think that sounds like you figured out how to make it work the last few months. I think that's something you can do, but also while you're doing that, now is the time to start building those financial habits in place, because if you don't start building financial habits now, then bad habits will just go with you the rest of your life. And I mean, if you start making a lot of money, it's going to go just as quickly. I mean, you look at lottery winners, you look at professional athletes that come into large amounts of money that never learned how to manage money correctly. It goes away just as quickly as it came in. I mean, most professional athletes go broke within the first 5 to 6 years of coming out of the leagues. Lottery winners, 70% of them or so go bankrupt within 5 or so years. And right now, being young, you have all the time on your side to start getting all this debt, paying it off, and start building financial habits that are going to pay off tenfold over the course of your lifetime. And that includes paying off credit card debt. That includes paying off high interest debt like 8% loans. And then once you start doing that, hey, guess what? You do that by the time you turn 30, you're going to have all the time in the world on your side to start investing for your future and start building real wealth before you want to retire, you want to buy a house, or whatever that life goal is. So, do you know how much money you would have at age 67 if you started investing $500 a month from 30 to age 67?
Isn't it like $600,000? Like it would have been better if I started at 25.
Yeah, so if you invested $500 a month from 30 to 67 and average a 7% rate of return, you'd contribute about $222,000 over those 37 years, but it'd be worth $1.04 million.
Wow, okay, I made it up to the million.
And if you start at 25, it'd be $1.5 million, which is an additional $30,000 contributed over those 5 years. If you started that at 20, then technically it'd be $2.2 million. And so right now, but if you wait until you're 50, it's only gonna be $195,000. So that's why it's important to start doing that now while you're young.
That's why I was like, I was gonna throw it in. I was just gonna get a little ahead of it, but I hear you.
But you can't get ahead of it when you got credit card debt or you got 8% loans, because this is assuming a 7% annual rate of return, which is lower than both the credit card debt and the student loans right now.
But wouldn't it compound in that 50th year? So, I mean, this is just like a thought experiment, right? So you're saying that because the 26% return is less than the 10% return, it's more than the 10% return I would see in the investment, right? But as you just mentioned, it compounds over time. So would, let's say, the $7,000 investment I make in my Roth IRA, I mean, probably not because you're sitting here telling me, but I'm just going to beat this horse. $7,000, 29 years of age, at that like 60, now I get an extra year, and that's like what, fucking 31 years of fucking, instead of 30 years, is that extra, but it's like, because it's not just 1 year, it's like compounded, is it not?
Credit card debt, 1 year and done, like interest rate. I mean, if you got, right now you got $6,000 worth of credit card debt.
But if I paid it off, like theoretically, if I still paid it off within the year, wouldn't it have been better to invest the money if I'm still going to clear the debt by the end of 2020, like by 2025?
No, because you would have paid $2,000 in credit card debt in the 12-month period if you have a $6,000 balance, and your money that year would have returned you $400. So that means year two, it might have returned you $450 or $500. Year three would have been $600. Guess what? You paid $2,000 in interest alone during that same time period.
Fine.
So, I mean, the credit card debt is a 26% interest rate, and that's directly comparable to a 7% return in terms of it's going to cost you on $10,000, $2,600 versus on that same $10,000, you'd earn $700. And so you're just basically it's $1,900 that you're paying to credit card company in that situation. So no, you're never going to out earn credit card debt, and also risk free. I mean, who knows? The next 10 years could be a economic recession, or the next 10 years could be an economic just rocket ship that you're earning more than that. But the issue is you don't know, and you have no control unless you're magic right now and you can predict the future. You have no idea where the trajectory of the economy is going to go, what events are going to happen, wars, diseases, COVID, who knows, could affect the market. And there's no point in trying to risk it when the odds are not in your favor. So what do you think the best financial lesson you've ever learned is?
Make money.
Make money. Income does help, but do you know what percent of people making over $100,000 a year live paycheck to paycheck? It's like, I think it's 49% or 49, 50%. So making money definitely can help pay down debt faster, but a lot of the times it's not necessarily an income problem, it's a spending problem, and it's a bad habit problem. A lot of people will say, hey, I'm living paycheck to paycheck, and you look at their credit card statements and they got $1,000 worth of shopping or Target or DoorDash or smoke shop visits, when it's not necessarily an income problem. It's, hey, we got bad habits and we're spending them and living above our means. So income helps you get out of debt faster if you reel back the spending, but a lot of time it's you got to fix your spending habits and your money habits before increase your income. Otherwise, same thing. Professional athletes, they get it's not an income problem. They go make $5 million, but guess what? They go spend $4 million of it buying everyone a car, a house that surround them. And that's typically what happens. Or lottery winners. I mean, the lottery winner this past year won $1 billion, $600 million or something after taxes. Hopefully he'll be okay, but he spent like $90 million in real estate the first year in Los Angeles. So he bought $90 million worth of houses that's probably cost a couple $1 million a year to keep upkeep. Theoretically, he'd be fine if he invests the rest of that money, but those are just habits that frankly probably aren't the smartest thing to do. Maybe if he went and spent $20 million in one house and invest the rest of it, sure, but spending $90 million in 3 houses does not seem like the smartest idea 1 year out of winning the lottery. So income can help, but it also, if you don't fix habits or you don't learn how to manage your money, income can destroy you just as easily. So a lot of people live paycheck to paycheck and they go get a new pay raise, they get a pay raise or promotion, and guess what? The money disappears because they go finance a new car, they go buy a bigger house, or they go on vacations. So it's a component of building wealth as income, but making sure you have the proper foundation and habits is a very, very large component as well. Does that make sense?
Yep.
So my suggestions, JJ, would be after this to you is first, I'd be paying off that credit card debt tomorrow because I hate credit card debt. You're lighting $170 a month on fire basically right now. You have the money in your checking account to pay it off. So I'd be paying that off. You'd have $30,000 after you pay that off and set aside $10,000 for taxes. I'd then be looking at what is your plan to pay off the student loans after that. Is it your goal to pay it off in the next 6 months? Is it paid off in the next 8 months? I'd want that within at least the next 12 months and at least making tangible action to it. Don't pay just the minimum payments and have that sit around for the next 30 years of your life. I don't want you to wake up when you're 60 years old and still have student loan debt. And then next, you got to start budgeting. You got to start tracking every single expense, understanding where your money's going, and all the leftover money at the end of each month should be going towards paying off this debt. And then once the debt's paid off, hey, let's start investing in a Roth IRA. Let's start learning about index funds. And then you can start saving and investing. Instead of all the money that's going towards debt, let's start putting that towards investments, $1,000, $1,500, whatever that might be. And you can start saving and building wealth for the long term. And you'll have, you have the time on your side right now. So if you start investing $1,200 a month next year, because you've paid off all this debt, you've increased your income, guess what? You wake up when you're 67, you should have around $2.5 million. That's not a bad spot to be in. And that's investing $1,200 a month. And if you can continue to grow and increase your income, you can do more than that. So does that make sense?
Yep. Crystal.
So what are you going to do after this?
Gonna go wake up tomorrow, pay off all my debt. Then I'm gonna budget.
I don't feel like I've gotten you sold on everything, but I guess only time will tell. So
Well, only time will tell. We'll see.